In this video, we will show you how to determine intrinsic and extrinsic values in options contracts. First, it is important to understand that the premium value of an options contract is made up of both the intrinsic and extrinsic value. So what does the intrinsic value refer to? In options trading, intrinsic value is the difference between the current price of an asset and the strike price of the option. It is used to determine how in the money an option is, or how much profit currently exists. So how do you find out what the intrinsic value is? First, determine the premium of the options contract. The premium refers to the price of the contract, the amount you would need to buy call or put options. Let's look at an example where Apple, AAPL, is trading at $165.56, with strike price of the call option contract at $165. This would mean that the options contract would have an intrinsic value of 56 cents. It's important to note that the intrinsic value does not equate to the price of the options contract. The intrinsic value is just one of the many components that make up the option premium or price. Therefore, it does not represent actual profit on the trade, but shows how in the money an option is, considering the strike price and market price of the underlying asset. This also will mean that out-of-the-money contracts will not have intrinsic values. Now, let's dive deeper into what extrinsic value means. Extrinsic value refers to the portion of the options premium, made up of the time value and implied volatility. Using the same example as before, where the stock is priced at $165.56, if the call option with a strike price of $165 is priced at $1.15, we have earlier deduced that the intrinsic value is 56 cents. The premium value of an options contract is the sum of its intrinsic and extrinsic value. We can then deduce the extrinsic value to be $1.15 minus 56 cents equals 59 cents. As extrinsic value is affected by time value and implied volatility, an option contract with 6 months to expiration will have more extrinsic value than one with a closer expiration date. When the market is experiencing higher volatility, this results in a wider price distribution. This means that the price of the stock can experience large price swings in both upward and downward directions. The opposite applies when market is experiencing lower volatility. We hope that this video has helped you understand how intrinsic and extrinsic values in options contracts are deduced. Stay tuned for more tutorials. Trade options with Poems Mobile 3 app. Talk to our options specialists at 6531-1225 for assistance. Your partner in finance since 1975.